Hi, I'm Tingwei Chiang, and I'm a certified financial planner with Cutler Investment Group. I've always been fascinated by numbers and strategies. Being a planner has given me the opportunity to turn what I love into a fulfilling career. But more importantly, I believe financial planning is one of the most impactful ways to empower individuals and families to achieve their goals, and it is incredibly rewarding to be a part of our clients' financial journeys. Outside of work, I enjoy traveling and hiking with my longtime partner, Jason. Thank you for joining Cutler's webinar. As we navigate the holiday season, many of us, myself included, are busy searching for the perfect gifts for our loved ones. While we are focused on finding the right present, it is also important to be mindful of gift tax rules. So we've put together this presentation to help you understand the basics. Please note, this presentation focuses on reporting and taxation of gifts from one individual to another. So charitable gifting and gifting for estate planning reasons are outside the scope of today's discussion. However, they are important planning tools, and your Cutler advisor can help you with those gifts. Please take a moment to review our firm's disclaimer. This presentation is for informational purposes only and should not be considered individual advice or a recommendation. Most people don't spend a lot of time thinking about gift taxes because the IRS provides each taxpayer a lifetime gift and estate tax exemption of $13.6 million in 2024. This amount increases to nearly $14 million in 2025. This means most gifts won't trigger any tax. However, the IRS may still require you to report the gift. Today, we will consider the following topics. What is considered a gift by the IRS? Is the gift reportable? How do we determine the value of that gift? And how do we actually report the gift? Finally, we will look at documentation requirements for charitable gifts. So what is considered a gift by the IRS? Perhaps it is easier to understand what is not a gift first. The IRS specifically lists 4 transfers as non-gifts. The first one is a transfer to a political organization. Any kind of political contribution is not considered a gift. The next transfer is to a certain exempt organizations, for example, civic leagues or business leagues. Those are also not considered gifts. The third type of transfer is a qualified tuition payment. Now, the IRS has specific rules about tuition payments in this scenario. The tuition payment must be paid directly to the institution, and the amount paid can only cover tuition. If you fulfill those criteria, that transfer is not considered a gift. Finally, qualified medical costs are not considered gifts. Similar to tuition payments, you must make that transfer directly to the institution that provided the care. Now, medical costs can cover the cost to treat, diagnose, cure illnesses, but it can also cover the cost of medical premiums. Now let's take a look at the official IRS definition of a gift. The IRS writes, generally, the transfer of any property or interest in property for less than adequate and full consideration, measured in money or money's worth, is a gift. It's a lot of words, but really what the IRS is saying is, anytime you give someone something and don't receive its fair market value in return, you have officially made a gift. Let's take a look at some examples of gifts based on the IRS definition. The first category, free transfer of property, is pretty clear. If you give someone something and receive nothing in return, it is a gift. The second category is interest-free or below market rate loans. This commonly occurs in intra-family loans. For example, in a scenario where parents make a loan to their children to help finance a home purchase. If the interest rate charged is significantly lower than the prevailing market interest rate, the IRS considers the foregone interest as a gift. The third category is debt forgiveness. If this were a loan between an individual and a bank, and the bank forgave the loan, the forgiven amount is usually considered income and taxed to the individual as income. Between family members, however, the IRS will typically start with the presumption that it was actually a gift. And then lastly, this is a scenario that we see frequently. It occurs when parents add children to their account for convenience purposes, to help pay bills or manage expenses, for example. If all the funds in the account belong to the parent, and the child withdrew more than the annual exclusion amount for their own use, the withdrawal could be considered a gift. The annual exclusion amount for 2024 is $18,000, and it increases to $19,000 for 2025. Now that we know what the IRS considers as gifts, let's look at which ones are reportable. Fortunately, the IRS doesn't want to know about every gift that we give. As we mentioned in a previous slide, if the gift falls below the annual exclusion amount, it does not need to be reported. Gifts between U.S. citizen spouses are also not reportable. This is because spouses are considered as one unit and enjoy an unlimited marital deduction. Finally, charitable gifts may be excludable. If a taxpayer only made gifts to charity, they will report these for a charitable deduction on their income tax return, but they do not need to file a gift tax return. However, if in the same year they also made reportable gifts, then the charitable gifts will need to be included on the gift tax return. What are some gifts that are reportable? For starters, any gift above the annual exclusion amount must be reported. What are some gifts that are reportable? For starters, any gift above the annual exclusion amount must be reported. For married couples, if one spouse is a non-U.S. citizen, the unlimited marital deduction does not apply. And any gift above $185,000 to the non-U.S. citizen spouse must be reported. This amount increases to $195,000 in 2025. Gifts that are subject to gift splitting is also reportable. Gift splitting allows a couple to split a gift to avoid potential gift tax. Under gift splitting, the IRS looks at the totality of the gift to determine if gift tax applies, and it treats the gift as being made equally by both spouses. This is particularly helpful when only one spouse owns the asset to be gifted, or if the spouses gifted unequal amounts throughout the year. Finally, any gifts of future value must be reported. A future value gift is one where the recipient must satisfy some condition before they have full access to the gift. One of these conditions, for example, could be they must reach a certain age. These gifts are outside the scope of today's discussion, but please reach out to your Cutler advisor if you have any questions on them. If a gift is reportable, the general rule is the donor must be the one who reports the gift. Now that we know how to determine if a gift is reportable, we next need to figure out how to value this gift for reporting purposes. The easiest gift to value is cash. The cash value is the gift's value. But what about non-cash gifts? How do we value those? Let's take a look at some common non-cash gifts. If the gift was stocks, bonds, or any other publicly traded security, the value of the gift is the average of the highest and lowest price on the day the gift was made. If it was made on a day that the stock market was closed, additional rules will apply. But in general, the average is what you are going with. If the gift was real property, for example, a house, the value of the gift is based on a recent appraisal or a comparable sales analysis. Below market loans and forgiven debts are harder to value, so we recommend you consult with your tax professional to determine the valuation. Now that we know we have a reportable gift and we know its value, let's look at how this gift is actually reported to the IRS. As long as you provide all the gifting information to your tax preparer, there isn't much else for you to do. Your tax preparer will help you file IRS Form 709, which is the gift tax return. The form is due the same day as your income tax return, which is generally April 15 of the following year. Here are some interesting things you may not know about the gift tax return. First, it is an individual return. Each spouse files their own return. There is no such thing as a joint gift tax return. Now let's talk about gift splitting on the gift tax return. There are some interesting points to know about gift splitting. Couples must be married and both must be U.S. citizens to elect gift splitting. If a gift was made while the couple was married and they subsequently divorce in the same year, they can still elect to split gifts as long as neither spouse remarried during the year. Another interesting point about gift splitting is it is an all or nothing deal. You cannot elect to split some gifts, but not others. Once elected, all gifts are split equally amongst the spouses. In addition, under gift splitting rules, all gifts must be reported, even if the gifts are under the annual exclusion amount. Don't worry though, this doesn't mean those gifts are subject to gift tax. The annual exclusions are pulled in separately in a different section of the form, so they are accounted for. If you made reportable gifts where a gift tax return is required, and you also made gifts to charity in the same year, you must report the charitable gifts on your gift tax return. Similar to gift splitting, the charitable gifts are not subject to gift tax because the deductions are pulled in under a separate section of the gift tax return. One final thing I would like to point out about the gift tax return is in regards to front-loading a 529 account. The IRS allows taxpayers to front-load up to 5 years of gifts into a 529 account. For a single taxpayer in 2024, this means up to $90,000 can be added to a 529. If the account is front-loaded, a gift tax return must be filed, and the IRS treats the gift as being made ratably over 5 years. Let's use an example here. Suppose I front-loaded $45,000 into a 529 account for my nephew. I cannot say I made $18,000 gift in 2024, $18,000 gift in 2025, and another $9,000 gift in 2026. The IRS will treat this as a $9,000 gift for each of the 5 years starting in 2024. The very last part of this presentation moves away from the gift tax return and brings us back to charitable gifts. In order to substantiate your charitable gifts for income tax deduction or for gift tax filing, the IRS requires taxpayers to retain certain documents. Let's start with cash gifts. If the cash gift was under $250, a pay stub, bank statement, or written receipt is sufficient. If the gift exceeded $250, you must obtain written acknowledgement from the charitable organization. If you donate non-cash gifts, the requirements are more stringent. If the non-cash gift is less than $500, the requirement is similar to cash gifts. If it is between $500 and $5,000, in addition to a written acknowledgement, your tax preparer must also file an additional tax form. If your non-cash gift exceeds $5,000, a written appraisal may be required by the IRS. With the holiday season upon us, many of us turn our thoughts to the joy of giving, and we hope this presentation has been informative and valuable. The rules surrounding gifting can be complex. That's why we're here to support you every step of the way. If you have any questions or need further clarification, please don't hesitate to reach out to your Cutler advisor.